Well, it's Monday, March 2nd, and it's been a big week for legacy tech stocks. This past Monday, IBM, basically the original American computing company, lived through its worst nightmare. Shares cratered 13.2% in a single trading day. To put that in perspective, we haven't seen a single day drop like this for IBM since October 2000, back when the dot-com bubble was about to burst. We're talking about $31 billion of its market cap from its opening bell to the clocking out, gone. And it wasn't because it was failing its earning report or some big catastrophe at its data centers. It was simply a blog from Anthropic. And to understand why Wall Street panicked, you need to understand COBOL. COBOL is a programming language from 1959. It's older than the moon landing, but it still runs the world. Roughly 95% of ATM transactions and 80% of in person credit card swipes rely on billions of lines of code of COBOL, mostly running on IBM Z series mainframes. For decades, this was IBM's safety net. Monetizing these systems was considered a mission impossible. It required armies of consultants, mostly from IBM, to spend years and billions of dollars just to map up the code and what it was even doing. If you were a bank, you didn't leave IBM because you wanted to. You stayed because leaving would be too expensive and risk so many catastrophes. However, Anthropic this week unveiled a specialized version of its Claude Code. Unlike the AI assistants of 2024 and 2025 that just struggled to put snippets of Python, this 2026 iteration is a specialized agent engineered to ingest, interpret, and refactor COBOL into modern cloud-native languages like Java or Python, with a claim of 99.9% accuracy. Anthropic's pitch was a direct shot across IBM. They claimed that their software can do quarters of what would take years for IBM to do. They're efficiently automating the very consulting hours that kept IBM's lights on. Investors heard the word automation and translated it immediately to obsolescence. If a bank can use an AI agent to migrate off of a mainframe at the fraction of a cost, IBM doesn't just lose its consulting fee, they start to lose their hardware refresh cycles and software licensing. And it's a whole threat to their entire existence right now. Now, IBM isn't sitting still. They spent the last few days doing damage control. IBM Senior VP Rob Thomas essentially told the market to slow their roll. IBM's agreement is that translating code is the easy part. The real challenge is data architecture, transaction integrity, and the sheer reliability that mainframes provide. They've been pushing their own What's Next code assistants for years, arguing that IBM truly understands the code of the global finance. But the market is currently in a selling mood. The fear that if even Anthropic is 70% as good as they claim to be, the pricing power of IBM that's enjoyed for the last century could effectively be gone in a few years or even a few months. And maybe you'll even want to place a bet on it, which leads us to our next story. In a series of bombshell disclosures, Kalshi has officially declared war on its users. They've unveiled the results of over 200 internal investigations, resulting in heavy fines, multi-year bans, and federal referrals. If you have insider information on a YouTube video or political race, the market is no longer your infinite money ATM. The biggest headline involves the world's largest creator, MrBeast. On Wednesday, Kalshi suspended and fined Artem Kaptur, a video editor for Beast Industries. According to Kalshi enforcement lead Robert Denord, Kaptar wasn't just a lucky guesser. He was using his proximity to MrBeast's production schedule to place bets on specific outcomes of upcoming videos. We're talking about markets with low odds where he had a near perfect success rate. He placed about $4,000 in trades, which is a pretty small amount, right? But the penalty was pretty heavy. Kalshi froze his accounts before he could withdraw any of it, then hit him with a $15,000 fine and ordered him to return every cent of profit. The total cost was about $20,000 and a 2-year ban. Beast Industries has already launched its own independent investigation, stating that they have zero tolerance for employees using proprietary information to gamble. It turns out that knowing the end of a $5 million video before it's even edited isn't just a perk, it's material non-public information. However, the crackdown doesn't stop at just YouTube. Kalshi also took aim at the political world, banning former California gubernatorial candidate Kai Longford for 5 years. Longford's mistake was that he bet on himself winning, then went on social media to brag about it, encouraging his followers to drive up the price. Kalshi said it violated its Rule 5.17, stating if you are the decision maker in a contract, meaning you can influence the outcome, you are legally barred from trading on it. Longford learned that with a $2,000 fine and a complete ban from the platform. While Kalshi was handing out fines, other authorities were handcuffing people. Earlier this month, Israel police arrested individuals in a high-profile case involving Polymarket. These people weren't just board editors, they were individuals accused of using classified military information to place bets on the timing and scale of military operations in the Middle East. This is where the fun of prediction markets hits a really big wall for national security. These arrests marked a turning point where governments are now threatening prediction market manipulation with the same severity as SEC inciting trading violations. Kalshi CEO said that when people believe a market is unfair, it dies. By sacrificing their own whales and high-profile users, Kalshi is trying to prove that they are a legitimate financial exchange and not just a digital casino. We've seen how desperate people are to find a sure bet in the prediction markets, even if it means risking jail time. But there's a reason investors and creators are looking for alternative ways to make a dollar now. The traditional entertainment engine of the last decade, video games, is officially plateauing. For years, we've been told that video games are pretty recession-proof and are bigger than Hollywood. But as we close out February 2026, the data tells a different story. And it's not just that the hype has gone past the pandemic era, it's a very culture of gaming that is undergoing a silent constraint. And to put it simply, the gaming industry is still making money. It's just that fewer people are actually playing these games. According to data from Circan and Newzoo, the share of US population that play video games has fallen by 3% since its peak. That might sound pretty small, but in a mature market, that represents millions of people who have simply put the controller down and retired. Revenue for the start of 2026 is technically flat, but if you look at it closer, it reveals the only reason why revenue isn't dropping is because the industry is squeezing more money out of people who are actually still playing video games. Base game prices have gone towards $80 while premium editions roughly touch $150. And we're seeing this squeeze of the remaining fan base to hide the fact that the gaming population is just walking away from it all. The biggest problem for these giants like EA, Ubisoft, and Sony isn't that just people are playing less, it's what they're playing. In 2026, the forever games have become a prison for the industry. A staggering 72% of all console playtime is now spent on titles that are over 6 years old, which include Fortnite, Roblox, Minecraft, and Grand Theft Auto 5. New AAA games are launching basically into a black hole of attention. Why would a 19-year-old spend $80 on a 20-hour campaign when their essential social life is built around a free-to-play game that they've been playing since middle school? And it essentially has turned the AAA Cold War where studios are spending upwards of $300 million on a sequel, only to realize their audience is too busy playing a 10-year-old game. And money is starting to notice this. Venture capital investments into game studios fell over 55% since last year, We're seeing a massive brain drain as top developers realize that the math isn't adding up anymore. Instead of building the next great RPG, the smartest engineers are fleeing to build a Duolingo styled gamification app or AI assistants. As one analyst put it, why gamble on a game that could be the next Concord when you can just build an AI tutor app that would 10x a profit margin with a quarter of the risk? And gaming is basically left to the actual true believers of this industry. So is gaming dead? Not really, but the era of new games is definitely on its last leg. What we're seeing in 2026 is a messy correction, and the industry finally admitting that it's become too bloated, too expensive, and too demanding of our time. The winners of this year aren't going to be the $200 million sequels. They're going to be weird indie games, chaotic, co op, and hits like Peak and Repo that don't take things too seriously and are meant for more casual gamers. As we discussed the gaming world shrinking and the smart money fleeing away from the gaming industry, but in the world of prestige TV and film, two players are done fighting. For the last 30 months, we've watched an unpredictable high stakes game for the soul of Hollywood. On one side, there was Netflix, and on the other was David Ellison and his newly minted Paramount Skydance. And it's finally over. And it's finally over. Netflix has walked away from the bidding war for Warner Brothers Discovery. After weeks of rumor, Netflix finally admitted that when it came to the price of its legacy, even its pockets had to reach an end. To understand why Netflix is out, you have to look at the math. Netflix wasn't trying to buy all of Warner Brothers Discovery. They only wanted specific pieces of it. Their $83 billion deal was focused on the crown jewels, which is Warner Brothers, movie studios, the DC Universe, and HBO Max. Netflix wanted the content, but they wanted to spin off the rest of it, the old world cable networks like Discovery, TNT, and CNN into a separate company. Then came Paramount Skydance. David Ellison didn't want a piece, he wanted everything and put in an all cash offer of $111 billion for 100% of the company, which is $31 a share, and no spin off, no complicated stock miniverse, just a massive check backed by the Elson family fortune and a $57 billion debt commitment from the biggest banks on Wall Street. The Warner Brothers board looked at Netflix, asked, "Can you do 83 billion and $1?" And Netflix said no. The board waited 4 days for Netflix co-CEOs to raise their bids. Instead, we got a statement that will probably be studied in business schools. They said this transaction was always a nice to have at the right price, not a must have at any price. Netflix is currently the only streamer making significant profit. By walking away, they signaled to investors that they won't wreck their balance sheet just to win over a trophy, and they'd rather take up the $2.8 billion breakup fee Paramount now owes them to buy back their own stock. So what is it going to look like now? Well, there's still a big if California will allow this merger to basically be the largest media conglomerate in US history, because it'll be a single entity owning CBS News and CNN, a single studio that owns Top Gun and Harry Potter, a streaming service that combines HBO with the reach of Paramount Plus. And now that the bidding war is over, Netflix is betting that content is king and they continue to grow organically, while Paramount is betting on scale as they buy up their way to the top. And by the end of the week, Netflix shares were up 9% because investors love that they were able to stick to their own plan, while Paramount shares are also up as they win the bet. And while the rest of the market is hovering over these mergers and acquisitions, Celsius Holdings is having a riot. They didn't just beat the earnings report. Celsius surged 14% in a single day as they take a sledgehammer to a traditional energy drink category. Celsius reported a staggering $2.5 billion in annual revenue. The secret? They acquired Ali Nu. Last year, and it has proven to be the deal of the decade. The brand alone contributed $1 billion in sales in just 9 months, while legacy brands like Monster and Red Bull are still fighting for the gamer and trucker demographics. Celsius has successfully captured basically the lifestyle market. They now own 33% of zero sugar energy drinks category. In 2026, Celsius isn't just a drink, it's a fitness utility. Investors are piling in because unlike the housing market, health consciousness doesn't really care about interest rates. If you can't afford anything, at least you can look like you went to a gym. And transitioning from the gym to the couch, Papa John's is having a really rough week. Shares are near its 52-week lows after the company missed revenue estimates and announced that they will be shutting down 300 locations by the end of 2027. The pizza pinch is real. Consumers are tired of premium fast food prices. When a large pepperoni delivery touches nearly $35 after fees and tips, the value just isn't there. Papa John's is currently caught in no man's land. They aren't cheap. They aren't as cheap as Domino's, and they aren't as prestigious as a local artisanal pizza shop. In the world of high inflation, the middle road is just a real dangerous place to be. But the real pain is happening at the big box hardware stores. Last week, both Lowe's and Home Depot delivered what analysts are calling a reality check on the housing market. Lowe's CEO described a deep freeze environment. Homeowners are trapped by golden handcuffs when they have 3% mortgage rates and refuse to sell, which has crushed their housing turnover. Because no one is moving, the move-in renovation cycle is basically dead. People aren't buying new flooring. They aren't making $50,000 remodels. They aren't building new decks. They are in a maintenance mode. They are only fixing what breaks. Lowe's is concerned that they've already cut 1% of their corporate workforce and pivoting hard towards pro contractors just to keep their lights on. And moving on to the silicon debt trap, we spent the last few weeks watching legacy software icons like IBM crumble and retail giants like Home Depot warn about a freeze on consumers, a little more dangerous across the financial sector. And we'll call this the AI credit crunch. For 3 years, the world's lenders have been tripping over themselves to fund AI revolutionary products. But as of recently, this sentiment has gone away. A landmark Bank of America survey released last week shows that 45% of institutional investors now cite an AI bubble as the greatest single tail risk of the global economy, surpassing inflation and geopolitics. We're looking at a $1.2 trillion AI adjacent debt flowing through the system. And now, for the banks and private credit funds that wrote those checks back in 2024, are looking at them like a toxic asset. And why is this a tail risk and not just a whole tech problem? It's because the sheer concentration of the lending. Recent data from the Chicago Fed reveals that while direct bank exposure to AI might look low on paper, around 0.8% of total assets, the committed exposure shows the real story. For the largest US banks, credit commitments to AI adjacent industries now average 25% of their Tier 1 capital. If these borrowers draw down these lines of credit simultaneously because they can't find venture capitalists, it would have blown a hole right through capital reserves meant to protect the banking system. Jamie Dimon himself warned that software could be a surprise area of weakness in the next downturn. The core problem is what analysts are calling circular funding. In 2025, we saw a massive pattern where big tech companies were investing billions into AI startups, but with one condition, that the AI startups spend billions back on the parent company's cloud computing. And it looked like a revenue on a balance sheet, but when the movie was moving from one pocket to another and then back, it wasn't adding up right. Many of these startups took out massive loans to bridge the gap between their $400 billion annual burn rate and their measly $60 billion in actual revenue. Now that the tools like Claude Code are commoditizing software development, effectively killing these tech startups before they've even launched, the loans are starting to look a little rotten. UBS started darkening their outlook on private credit, forecasting default rates to spike as high as 4% for this year, significantly in the tech loan sector. And then there's the shadow bank problem. Private credit funds currently hold roughly 40% of all private equity backed software loans. Unlike public banks, these funds aren't regulated for safety nets. Last week, we saw Blue Owl Capital and Arrays Management saw their stocks plunge as investors realized their portfolios are top heavy with legacy SaaS providers, the very companies that are being disrupted with AI agents that we discussed earlier. And the golden age of private credit is facing its first real test. Lending is now demanding LTV refreshers, looking at the true value of the companies and not just the hype that they've been providing. And for many cases, the collateral just isn't there anymore. And the bottom line is that the AI boom was built on a mountain of debt that assumed that the technology would pay for itself within 2, maybe 3 years. And we're a few years in, and these people want their money back. And as we end the show, there are a few developments coming on. Things escalate quickly over the weekend. And as of today, March 2nd, 2026, the US and Israel are in the middle of a major military campaign, which has already seen the death of their supreme leader, causing the Strait of Hormuz to effectively become a no-go zone for global shipping. For your wallet, this basically means gas prices will increase and have already increased 10 to 30 cents per gallon over the weekend just from this conflict alone. Beyond the field, this conflict is facing cargo ships to basically go the long way around Africa to avoid all this chaos, which spikes shipping costs and trickles down to more expensive groceries, electronics, and retail goods. If this standoff drags on, it could reignite inflation we just spent years trying to cool down, potentially keeping interest rates high and making your next car loan or mortgage that much more expensive. But we'll keep you updated until the next episode. Thank you for listening.